Welcome back to Talk Tickers. This is the deep dive where we ignore the hold music, skip the safe harbor statement, and strip mine earnings calls for actual alpha. Today, we are focusing on the fortress balance sheet of the geopolitical world. We are looking at the heavy hitter, Lockheed Martin, ticker LMT.
The big one. And honestly, if you were just skimming the headlines on your terminal this morning, checking the pre-market movers, you might have been genuinely confused by the reaction here.
That is exactly where I want to start. Because we saw the stock pop. It surged over 4%, adding, more than $25 a share to close around $622?
Yeah.
That is a massive move for a mega cap industrial. Usually stocks like this move like glaciers. But here's the thing that usually kills a stock like this. They missed on earnings.
They did.
So walk me through this logic. In what universe does a company miss their earnings per share consensus and get rewarded with a 4% rally? I mean, is the market just broken? Or did everyone collectively agree to ignore the scoreboard for a day?
The market isn't broken, but the scoreboard has fundamentally changed. That's the vibe check for this entire deep dive.
Okay.
Usually, if you miss EPS, you get punished, you go to the penalty box. But the street looked right past the miss because the narrative has shifted entirely. For the last 5 years, the question for Lockheed was, can you get the orders?
Right.
Now, the question is simply, how fast can you physically build this stuff?
So it's purely a supply side story now. Demand is just assumed.
100%. The miss was a rounding error, but the guidance, that was that was a manifesto.
Okay. Before we get too excited about the future in the manifesto, I want to force us to look at the bad news first. I want to respect the print. GAAP earnings per share came in at $5.67.
Yeah.
The street wanted $5.83.
Right. And even on the adjusted basis, they were at $5.80. So technically a penny miss against expectations.
A penny miss. It seems small, but for a company that prides itself on precision, a miss is a miss.
It is. But in a company generating this much cash with this many moving parts, a penny is basically an accounting adjustment. It's noise. What the algorithms and the portfolio managers saw, what they actually care about, was the top line. Revenue hit $20.32 billion. The consensus was under 20.
And that's 9% year-over-year growth.
9% growth. For a defense prime, that's significant.
Right. Usually these guys grow at the speed of GDP, right? 2, maybe 3%.
Exactly. 9% signals that the factories are actually humming. They are moving metal. But the real mic drop, the reason the stock is trading at $622 right now, was the outlook.
Okay.
For fiscal year 2026, they are forecasting sales between $77.5 and $80 billion.
And the street was sitting at roughly 74.6. That is a massive delta.
They blew the estimates out of the water, and that flows down to the bottom line. They're guiding next year's EPS at almost $30 a share, specifically $29.35 to $30.25. But the number that I think literally made investors drool was the backlog.
I stared at that number for a while. $194 billion.
It's a record. It is an absolute mountain of money.
Put that in context for me. And $194 billion is a big number, but what does that actually mean for the business stability? How long does that sustain them?
Think of it this way. That is roughly 2.5 times their annual sales.
Okay.
It essentially means they could stop selling today, fire the entire sales team, disconnect the phones, lock the doors to the marketing department, and they would still have the next 2.5 years of revenue fully booked, signed, and waiting to be built.
That is a heck of a safety net.
It's more than a safety net, it's a moat. And this transitions us perfectly to the core theme of the call. CEO Jim Teichlick kept using this phrase, acquisition transformation.
Oh boy.
Now, be honest, when you hear acquisition transformation, what do you think?
I think it sounds like corporate buzzword bingo. It sounds like a PowerPoint slide that nobody reads during a mandatory HR training.
It absolutely does. But, and this is why we do the deep dive, when you dig into what they are actually doing, it feels like a fundamental shift in how the defense industry operates.
Go.
This is the most important takeaway from this entire earnings print, so we need to unpack it properly.
Go for it.
How is this different from business as usual? Defense contracting has been around for 80 years. What's changing now?
Traditionally, defense contracting is this painful annual dance. It's political. Congress passes a budget, or they don't, and we get a continuing resolution, and Lockheed gets an order for 1 year of missiles.
Right, just 1 year at a time.
Maybe 50, maybe 100. It's volatile. It makes it impossible to plan. You don't build a massive new factory for a one-year contract that might disappear if the political winds change in Washington.
Right, because Capital Allocation 101 says you need a guaranteed return to justify the expense. You don't pour concrete on a maybe.
Exactly. But Teichlick is changing the game. He's pushing for and getting these massive multi-year framework agreements. The headline here is what I'm calling the missile annuity.
A missile annuity?
Yeah. They aren't just selling missiles anymore. They are setting up utility-style contracts.
Give me the specs on that. Which systems are we talking about?
Look at the TAD system. This is the Terminal High Altitude Area Defense. It shoots down ballistic missiles. They are talking about quadrupling capacity, going from 96 interceptors a year to around 400. And this isn't a hope and pray goal. This is a concrete 7-year plan.
7 years. That is nearly 2 full presidential terms. That implies a level of stability we just don't see in this sector.
And it's the same story with the PAC-3 MSE, the Patriot Missile Interceptor. They are ramping from 600 a year to 2,000 a year.
Wow.
Production is already up 60% since 2023.
Okay, but I have to play the skeptic here. We know how the government works. They sign a contract today, and in 3 years, the geopolitical situation changes, or the budget gets slashed, or a new administration comes in and wants to pivot to drones instead of missiles.
What happens to Lockheed then? They built the factory, hired the workers, and now they're holding the bag.
That is the trillion-dollar question. And that is why this call was so significant. They explicitly discussed make-whole provisions.
Make-whole, meaning?
Meaning if the government changes its mind, which, let's be honest, is their favorite hobby, Lockheed has clauses in there to get compensated for the capital layout.
Oh.
It effectively de-risks the investment. It's like an insurance policy wrapped inside a growth contract. If they build the factory and the order is canceled, Lockheed still gets paid for the infrastructure.
That changes the risk profile entirely. It makes them look less like a cyclical industrial subject to the whims of voters and more like, well, a utility. Or a tech hardware company with a subscription model.
Precisely. And that brings us to the money they are spending. Usually when a company announces they are spending billions on capital expenditures, CapEx investors get nervous.
Right.
CapEx eats cash flow. It's money out the door today for a theoretical return tomorrow.
Right. Wall Street usually wants to see share buybacks. They want the cash now, not new buildings.
But here, the market loved the spending. They announced a multi-billion-dollar investment to expand facilities, specifically breaking ground on the Munitions Acceleration Center in Camden, Arkansas.
The Munitions Acceleration Center. That is a very aggressive name for a building. It sounds like a level in a video game.
It definitely does. But combined with R&D, they're approaching $5 billion in investment for 2026. The logic here is simple. You do not spend $5 billion building factories for 7 years of missile production unless you know the checks are going to clear.
Right.
The market sees this spend not as a cost, but as a signal of massive, unshakable demand.
So the CapEx is a leading indicator of future revenue. It's a signal.
It is the strongest signal you can send. You can fake a slide deck. You can't fake $1 billion factory.
Let's look at the breakdown, though, because LMT is a conglomerate. Not every division is firing on all cylinders. Who is the golden child right now?
It's Missiles and Fire Control, or MFC. No contest. They are projecting 14% growth next year.
14%.
In the world of massive industrials, double-digit growth is rare. That is the engine driving the stock.
And aeronautics. This is the F-35 program, the fighter jets.
It's the cash cow, but it's grazing. It's not running. They are holding steady at about 156 aircraft per year. Growth is in the low single digits.
Okay.
It's vital for the dividend. It provides the baseline cash flow, but it is not the reason you buy the stock for alpha right now.
And space.
Space is interesting, growing about 5%. This is driven by the next generation interceptor NGI and the Fleet Ballistic Missile. It's solid, reliable growth, but again, the fireworks are in missiles and fire control.
I did notice the CFO, Evan Scott, mentioned a bit of a catch regarding margins at MFC. He warned about a dip.
Yeah, this is the margin compression issue. He warned that margins might dip 20 or 30 basis points during the ramp up.
Is that a concern? Investors usually hate shrinking margins.
Not really. Think about the physics of it. Starting a factory is expensive. You have hiring costs, training, inefficiencies when you first turn the machines on.
Sure.
But the argument, and the market accepted this, is that while the percentage margin might dip slightly, the total profit dollars will soar because the volume is tripling.
So would you rather have a 12% margin on $1 billion or an 11% margin on $4 billion?
Exactly. I'll take the bigger pie every time. It's about total free cash flow generation, not just the percentage on the spreadsheet.
Okay, we've covered the finance and the strategy. Now I want to pivot to the part I actually enjoy, the hardware. Because amidst all this talk of contracts and acquisition transformation, they dropped some sci-fi level updates on what they are actually building.
They really did. This wasn't just a spreadsheet call. They flexed some engineering muscle.
Let's start with Project Blackhawk. When I think Blackhawk, I think of a pilot, a co-pilot, and a crew chief. But Teichlick describes something very different.
He described a fully autonomous Blackhawk, no pilot on board.
Just to clarify, this isn't a remote-controlled toy.
No. The way he described it, you could be sitting in a command post or even in the back of the helicopter itself, controlling the entire aircraft with a tablet.
Right.
You tap a destination on the screen, and the AI handles the flight, the terrain avoidance, the landing zones.
That solves a massive problem, doesn't it? Because the bottleneck in aviation isn't always the planes, it's the pilots.
It's always the pilots. Training a pilot takes years and costs millions. If you can use these for contested logistics, flying ammo or blood or MREs into a hot zone without risking a human crew, that changes the math of logistics.
Yeah.
Or think about the civilian application, fighting wildfires at night. Human pilots can't fly safely into smoke at night. An autonomous Blackhawk doesn't care.
It's incredible. And then there was the update from Skunkworks,
Yeah.
the 5th-gen team-up.
This is the future of air combat. They demonstrated an F-22, the premier stealth fighter controlling a drone wingman in flight.
So the pilot is no longer just a pilot.
No, the pilot isn't just a dogfighter turning and burning. The pilot is a quarterback, calling plays for a squad of robot drones that fly alongside.
It multiplies the force without multiplying the pilots.
Exactly.
And then space. They mentioned the Golden Dome.
This is missile defense on steroids. They're developing a space interceptor. The goal is to hit, as they put it, a bullet with a bullet in space.
And the timeline.
By 2028, this isn't a 20-year pipe dream. They are bending metal for this right now.
And finally, we have to talk about the lasers. We simply cannot do a deep dive without talking about lasers.
The Helios system.
This is the economic argument for defense, right? It's not just about can we shoot it down, it's can we afford to shoot it down?
It is, look, right now, if a cheap $5,000 drone is flying at a ship and you shoot it down with the $2 million interceptor missile, you might win the engagement, but you lose the war economically.
Right.
You go bankrupt protecting yourself.
It's terrible math. You run out of money before they run out of drones.
Yeah, exactly. But Helios is a laser. It costs pennies per shot, basically just the diesel fuel to run the generator on the ship. If you can use lasers to fry the cheap swarm drones, you save your expensive PAC-3 missiles for the scary stuff, the cruise missiles, and ballistic threats. It's not just cool tech. It's essential for the cost structure of modern warfare.
Okay, let's bring this back down to earth for the investor. We have high growth, guaranteed contracts, autonomous helicopters, and lasers. It sounds perfect. Where is the bear case? What goes wrong?
Execution. Execution is the new risk. The problem isn't, can we sell it? The problem is, can we build it? The supply chain is incredibly fragile.
Yeah.
They mentioned the F-35 has 1,900 individual suppliers.
1,900. That is 1,900 points of failure.
If one of those companies has a fire or a strike or runs out of specialized aluminum or gets hacked, the whole line stops. Labor and raw materials are the bottlenecks. They have the orders, but they have to physically execute, and that is hard, gritty work.
And what about capital allocation? Are they buying back shares? Because usually that's the floor into the stock price.
They are, but it's a secondary priority. Management signaled they are prioritizing investing in the business over immediate, massive share buybacks. They believe the ROI on building a missile factory for a 7-year contract is higher than the ROI on buying back their own stock right now.
Which is a very confident stance. It tells me they think their internal growth is better than financial engineering.
So, bringing it all together before we get to the trade idea, is LMT changing its identity?
I think it is.
Right.
For a long time, LMT was a yield play. You bought it for the dividend and safety. It was a bond proxy.
Right.
But with double-digit growth projected in missiles through the end of the decade, this is looking more like a growth compounder. Investors are starting to price it differently.
Right. That is the deep dive on the fundamentals. But now it is time for the segment where we throw out the textbook, lock the compliance officer in the closet, and get a little speculative.
Oh boy. Here we go. Please remember, What follows is not financial advice. We are basically role-playing as that overcaffeinated analyst in the back of a hedge fund, pitching a wild idea to the investment committee. Are you ready?
I'm ready. Pitch me.
Okay. I call this trade the Arkansas Ammo Box Spread.
Okay, Arkansas Ammo Box Spread. Okay, frankly, that sounds vaguely illegal.
It's not illegal, it's just aggressive. Here is the setup. We are entering a kinetic supercycle. The CEO basically said they are turning missile production into a utility bill for the government. It is fixed, it is recurring, and it is non-negotiable for 7 years.
Okay, so the demand is locked.
Correct.
Yeah.
But everyone is buying LMT. LMT is crowded. LMT is the obvious play, and LMT is huge. It takes a lot of money to move that stock. I want the leverage. I want the juice.
Right.
So here is the trade. First leg. You short the broad market indices that are exposed to consumer discretionary spending.
What?
Because inflation is sticky and the consumer is tapped out. Buying sneakers and lattes is discretionary. National defense is not. But here is the kicker. You go 3x leverage long on the specific supply chain vendors feeding that facility in Camden, Arkansas.
You are betting on the suppliers feeding the beast.
Exactly. You don't bet on the guy selling the car. You bet on the guy selling the steel and the microchips. Look at the numbers. They are ramping past threes from 600 to 2,000 a year.
Right.
That is a 300% increase in physical stuff moving through that factory. I'm talking about the trucking companies in Arkansas. I'm talking about the specialized chemical producers making the solid rocket fuel. I'm talking about the local real estate around Camden.
So you are basically front-running the inventory restock.
Yes. You are betting on war. You are betting on the restock. The warehouse is empty, and the government just signed a blank check to fill it up. If they hit that 2,000 per year run rate, Lockheed isn't an industrial stock anymore. It is a tech hardware growth story with a government moat. But the suppliers are small caps. They are going to see their order books explode.
It's aggressive, it's a little reckless. But logically, it actually tracks. If that facility in Arkansas is the bottleneck, the people feeding it are going to have massive pricing power.
That is the Arkansas Ammo Box Spread. Do with that what you will.
I think legal is waving at us frantically through the glass.
They always are. So to recap the sane part of the show, we are bullish on the volume, cautious on the supply chain execution, but we are fascinated by this shift to long-term contracts.
It's a new era for defense contracting. Stability is the new alpha.
There's a wrap for this deep dive on Lockheed Martin. As always, none of this is certified financial advice. We are just two voices in your headphones trying to make sense of the noise.
If you enjoyed the show, rate and review us. And hey, if you have your own outrageous trade idea based on this missile ramp up, send it in. We want to hear it.
We'll catch you on the next print.